Thanks for being with us on the Asset Preservation Hour. Brad Johansen alongside Stewart Willis as we continue to try and educate. Well, Stewart continues to try and educate. And I have questions, which is probably a little bit off the board here. We talk about a lot of different things, but we very rarely talk about real estate maybe as an investment tool. So I want to do this because we're in that very strange time where we had a long stretch of buy because the interest rates are so low. And now the market changed so much because the interest rates went high. Now the interest rates start to come down again, and we ask questions. Real estate as an investment tool, let me throw that out there as an initial. Is there a reason we should be looking at that?
Yeah, I mean, look, some of our wealthiest clients are real estate investors, and it's for a couple reasons. One of them, of course, is that we've seen great appreciation in the real estate market because of the dropping of interest rates. It's also because Arizona is a very attractive state to Californians, right? They all want to come here. They're leaving the high tax states. They want to be a little more efficient there. But interest rates played a huge role in that. And so just understand, that the environment changed. For 35 years, interest rates dropped. And then obviously from 2020 on, interest rates started to, begin climbing. And, my wife all the time wants to get a bigger house. And
we do hear this.
Right. And the problem with it is that I have a 2.5% 30-year mortgage. I can never get rid of that. And so if I decide I want to buy a bigger house, I now have to buy that house, not with the equity from the old house, but with new money. And that'll be at a new interest rate. It certainly isn't going to be at 2.5%, right? But, the world has changed. The environment's changed for real estate. It's certainly, I don't see that it's going to appreciate in the same way it has been, especially because rates are higher, right? In a falling rate environment, great. If all of a sudden they keep going downward, yes, we'll see another, bull market in the real estate world. Thank goodness we've had the pressure from California, people flying here from, California, also the Midwest, a lot of retirees coming in here. But, also remember, as an older population moves to Arizona, retirees, they also die, right? And people aren't living forever. And so we're replacing, one group of people with the next set of retirees that are coming in. So you just have to be wary of the factors that allowed for real estate to do so well.
All right, let me broach another subject. People in real estate starting to hear, I'm thinking about buying property within my IRA. Mm-hmm. You go with it or warn against it?
So, it's a mixed bag. I generally don't think it's a good idea for, a couple reasons. Look, I have a client that's a great real estate agent. She looks for fantastic deals. She can identify deals. She doesn't have to pay commissions because she is the agent herself.
Yeah.
That's a different story, right, than having to pay 6%, every time.
Absolutely,
right? It's a different deal. So she can save herself the money, actually make the commissions herself, consider that a profit. But one of the big things that you lose by owning it inside an IRA is one of the biggest advantages of owning real estate. It's not just the appreciation of real estate that's made real estate attractive to big investors. It's also the ability to depreciate that property over 27 and a half years. And what that means, Brad, is that when you're buying a property, you're not just buying it to look at it. You're buying it to rent it out, to have a renter that, to make sure it's cash flow positive. So, depreciation allows you essentially to deduct a big part of the cost of that house over 27 and a half years. And so oftentimes, even if you're cash flow positive in a house, you can oftentimes show a loss from a tax perspective.
Okay.
In an IRA, you don't get any of that benefit. You don't get the ability to depreciate it off of your income because it's inside that IRA wrapper. The other thing is, when a house appreciates in value in a normal circumstance, not in an IRA, and you decide to sell it, you're selling it at a capital gain. So it's at a 15 or 20% rate. If you sell a house out of your IRA and you just say, hey, I need this $500,000 out of it, well, guess what? it's now ordinary income tax. So you lose the benefit of the lower capital gains rate and depreciation, which are some of the biggest advantages of having it inside this. And we see these, self-directed, real estate IRAs all the time.
All right, I was going to ask about self-directed. If we move to that, if you turn on the TV, you got a great chance of seeing an ad about gold. That would lead us to self-directed. Can you talk to me about gold and maybe something that we should be wary of?
Yeah, so gold IRAs are my pet peeve here. I think I understand that typically you only see gold advertised on conservative channels, right? It's people that, they're targeting a very specific audience for that. And gold and precious metals have their place. The problem inside a gold IRA is that, once again, gold doesn't move a lot in price. It's meant to be stable, right? The other problem is that when you buy gold inside an IRA, you're typically paying above spot. So it's usually 15 to 20% above spot. So if gold is worth $100 and you pay a 15% above spot, you're paying $115 for something worth $100. It's a commission. Well, when you go to sell it, you may have to pay another 15% to get out of it. So how the heck are you going to make up for 10 to 40% in fees and commissions? Because it doesn't move enough like that. It's also, oftentimes you're in a position of a fire sale. So this company, this third-party company, has all of these gold bars, apparently for you, and they're the custodian of it. And when you need your money, you call and you say, hey, well, my gold says that it's worth $165,000. I had a client that did this a couple years ago, and it said $165,000 on his statement. He calls up, and they said, well, yeah, but of course, there's the commission to sell it, so you'll get $150,000 for it. And he's like, well, then why does the statement say 165, right? There's fees to get out oftentimes. So what I did, my client, Mark, he's a fantastic guy. He's been with us forever, and we've been looking at this gold IRA thinking it was going to make money.
So he comes to you with this problem.
Yeah, he calls at its peak value. He calls, and so I call, and I say, listen, first of all, Mark, let me make a call for you, and I'm going to call the guy. Well, I called the gold IRA local here in Scottsdale. I said, hey, this is Stewart Willis from the Asset Preservation Hour. We're doing a show on the liquidity of gold IRAs. My client here, we gave him the account number. He's looking to liquidate out of this. And this statement says $165,000. I want to see if he can actually get this $165,000 out of this account. And of course, he realizes I have a TV show, and he says, well, Mr. Willis, 165 is the retail price. Of course, he's one of our VIP clients. We'll give him 175, and I said, well, is that all in 175 or are there fees? He's like, no, of course not. That's your 175. We're glad to hand it to him. But he couldn't have done that if I didn't say I had a TV show, because all eyes were on them, right? They were concerned about more eyes being on.
So they can play with the number depending on how you work it?
There's no market value to it when you add commissions to the top of it. When you don't know what you will get out of it ahead of time, what your contractual fee will be to leave, that's a problem, right? So, we were able to get him out of the problem. It saved him. He got out of it. He was happy. But at the end of the day, it's a problem, right? And so what happens when you now have to take required minimum distributions out of your gold IRA? You now have to sell it, and what happens? You're getting that water torture of death over time of commissions and fees just to get your money back. I think it's a mistake, and I'm telling you, if you're considering going into a gold IRA or a self-directed, real estate IRA, and you want to get a second opinion over whether it makes sense, or maybe you have them already and you're looking for an exit strategy of how to divest out of those positions, we're offering you a complimentary portfolio review. If you give us a call at 833-602-PLAN, that's 833-602-7526, or even easier, click on the QR code that'll take you to the assetpreservation.com website. We'd be glad to give you a second opinion, but you have to ask for help.
All right. Has your advisor been talking to you about potential real estate investments, potential self-directed IRAs, about gold? maybe you do need a second opinion at this time, and this is complimentary. Call the number on your screen, 833-602-7526. I mean, what should you be looking for in a financial advisor? We'll cover that when we return.
They've got quite an extensive resume. Wow, so many years of management. Bet that was fun. So this job requires basic knowledge of the social media and video platforms, content creation, and SEO. How proficient are you in those areas?
Going back to work after retiring is not ideal. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
And we will talk more about taxes coming up. Brad Johansen alongside Stewart Willis. We've talked about self-directed IRAs and real estate, and I led to the break saying, what should I be looking for as a financial advisor? So do you have a checklist of things that you should be looking for?
Yeah, absolutely. Number one, you want to make sure that the advisor you're dealing with is a true fiduciary. And when we talk about the word fiduciary, I know you've heard that word before. People throw it around loosely. What we're talking about is an investment advisor representative, someone who puts your interests above their own, someone that's obligated contractually to put your interests above their own. That's number one. It's also, and just remember, when we compare the investment advisor representative or the fiduciary to a broker's allowed to receive commissions and transaction fees from securities and mutual fund companies. So oftentimes there's hidden fees inside those funds that you have no idea are even there unless you read the prospectus. I think you want to make sure that whoever you're dealing with is working on your behalf, not just on their own behalf.
Okay, I throw out the word holistic because I think there's a lot of things within that. Even as we went to break and talking about, has your advisor talked about this? Give me an idea what a holistic plan looks like with an advisor.
Yeah, I think the second thing to look for is to make sure you are dealing with a holistic planner, someone that looks at everything. And they have to be independent. You want to make sure they're not beholden to any specific mutual fund, families or any sort of custodian. We use multiple custodians at Asset Preservation. We use Charles Schwab Institutional. We use Fidelity Institutional. We're allowed to use either of those or whomever we choose. So we're independent. But as a holistic planner, you want to make sure that your advisor understands, of course, investments. That's the minimum, right? But you also want to make sure that they understand taxes as well. If they don't talk about taxes, tax planning with you, I promise you, you're missing out. We are in one of the most efficient tax windows in history. If they're not doing advanced tax planning with you, you are paying for something and you're not getting enough for it. If you're paying for advice and they don't do those things, it's a problem. Also, they need to be specialists in estate planning. So Asset Preservation was founded back in February of 1997. We just celebrated our 26th year. We're almost at 27. We're darn near at 27 years now, right? 27 years in business. And our company was originally founded by a guy named Paul Mumford that created a company to be able to provide estate planning, living trust to people that weren't named Rockefeller. And you need to make sure you have your estate planning in order. We do living trusts. We do them only for our financial clients. We do them for under $1,000 with an attorney, not a certified legal document preparer, but a real attorney does all of our trusts for us. And you need to make sure your financial advisor can handle those questions as well. But I also say they need to be an expert in retirement planning because a lot of financial advisors focus on the growth of your money.
Sure.
But remember, there's 3 stages of retirement, right? There's the accumulation phase, the asset preservation phase, and then, of course, the decumulation phase, the time when you start needing access. And a lot of advisors don't focus on those retirees and those pre-retirees, and that is where we intentionally focus.
All right. You've gone down the list of fiduciary, independent, a full holistic plan. And I think a lot of people say, you know what, I've got to do business with this guy. I don't really like this guy, but that's kind of the price of doing business. You have a different view of that.
Yeah. Look, I tell people all the time, if you don't like me on TV, you're not going to like me in person. I am the exact same human being. And what I'm saying is, if you don't like me, don't call, right? And I get it. A lot of people don't like me. Call someone you like. But if you're in a relationship with an advisor, someone you don't particularly like, or you try to avoid those conversations, find somebody new, right? This is a business thing. It's not a personal decision. It's a business decision. And what you have to realize is that if you don't like that human being as a person, then you will find every excuse not to communicate with them, right? The reason I can work 6 days a week, 12-hour days, is because I hang out with people I like. I hang out with employees of my firm that I enjoy, and I only surround myself with clients I like as well. And if you don't like your advisor, you need to take a second look and see it. So if you're in a relationship with somebody that you don't like, a financial advisor that isn't giving you the time of day, or maybe they're not a holistic planner, they aren't looking at your estate planning, and you haven't even set up a living trust, they don't look at tax planning, and they don't have a CPA on staff, you need to get a second opinion to see what you're missing out on. And we're offering you an absolutely free analysis of your estate planning portfolio, of your tax scenario, and what kind of risks you're taking inside your portfolio. But you have to take action. If you give us a call at 833-602-7526, or even easier, pick up your phone, click on the QR code that's at the bottom of your screen. That'll take you to assetpreservation.com, where you can claim your absolutely free portfolio review.
Some people coming in on this, Stewart, now are coming in as television. You do radio as well, and they may not know that that's available to them.
Well, they have said I have a face for radio, and I don't know if they're trying to insult me.
I'm zipping it. I'm zipping it.
No, but yes, we're on KTAR and KFYI AM 550. We're even on the Patriot radio station as well. So we've got channels all over the place here on our radio. We're covering it all. Now that, and it's funny with such a broad reach with the television show and the radio shows. Now that we're opening our office in Gilbert, people are getting excited. So if you're in Gilbert and been hesitant to call because you don't want to drive in, that office will open soon. You can meet at our Tempe office until Gilbert's open here in the next month or two. We'd be glad to talk, but you have to ask for help.
Yeah, the opportunity is for you right now. 833-602-7526 for a complimentary review. Costs you nothing. Do it now. Have we talked about taxes? We'll do that when we come back.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Stewart Willis with Asset Preservation Wealth and Tax. If you have amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. We are in one of the greatest tax windows in history, so it makes sense to take advantage of this tax discount while you can with your partners in retirement. All of our expert advisors, CPAs, and enrolled agents are fiduciaries that specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
Welcome back to Asset Preservation Hour. Brad Johansen with Stewart Willis, who was just talking about taxes and why this is such an opportune time. We always talk about the rules changing. The government can do it whenever they want. Right now, we know what the rules are, and some of the rules actually benefit you better than any other time in history. So why should we act?
Well, because we know that window is closing, right? We know that we are in the most efficient tax window in history right now for the middle class. And, oftentimes people politicize it and say, hey, this Tax Cut and Jobs Act only benefited the wealthy. It's just simply not true. Our average client is between the 12% bracket and the 24% tax bracket, which is a wide window. But that is certainly not the ultra wealthy. That is middle America that does their job. They put money away. They've done, they work hard and they have a pretty decent income. But here's the thing. At the end of 2025, the Tax Cut and Jobs Act is set to go away and sunset, and taxes are going up dramatically. So we think it's important to not just have a financial plan, but have a tax plan as well. And look, I talk about taxes all the time, and I tell people that, for the first decade of my career, I really feel like I was faking it because I didn't understand tax. Taxes are a lot of additional work. Brad, I'm telling you, tax season, it's a nightmare. I mean, it's 2.5, 3 months of, we did 1,200 tax returns here in Phoenix, or in the Phoenix area. And it's a lot of work.
It's a lot.
It's a lot, but you know what? The result we get is dramatically different. Yes, we add a lot of additional work to our plate. Yes, we add a bunch of additional staff. But you know what? I'm absorbing the cost of that. We don't pass it on to the clients. It's something we believe that advisors need to do. If your advisor's not talking about tax, you're getting half the story.
All right. There's some list because we talk about the government and changing rules. I want to kind of go into Build Back Better and what that kind of led us into and the potential that we were kind of nearing a cliff, right?
Right. So what Build Back Better did back in 2019 is it essentially showed us the cards of, some of the population. Basically, Democrats wanted to raise taxes substantially. They wanted to get rid of step-up in basis for capital gains. They wanted to tax you on capital gains as they were growing. They wanted to assess capital assets and tax you on that, which would just be an impossible thing. And eventually they asked for too much and it didn't pass.
Yeah.
I know Kirsten Sinema was one of the reasons it didn't pass. And so I thought that was a good thing. And I'm not trying to get too political here, but they also tried to get rid of the Roth account by starting with the backdoor Roth. And so, just understand when people say, how do we know the Roth is going to be here forever? We don't. We know it's here now. We know you can convert to Roth now and take advantage of the most efficient tax window in history. I cannot tell you what's going to be allowed tomorrow or the next day or the next year. All I know is that right now, we have the capability to convert all of your pre-tax assets over to Roth, to pay taxes on those now, to diffuse that tax time bomb so you have a real plan going into the future.
All right. Are there advisors talking about Roth conversions at this point?
Well, I think they're forced to. It's funny. I have a really good friend of mine that works at one of the big box shops here.
Okay.
And she's like, oh my God, Stewart, you're killing me with all this Roth conversion talk, because all of these clients come in and say, hey, the Stewart guy keeps talking about Roth conversion. Does that work for me? Here's the problem I put them in, these advisors. And she is fantastic as a human being, but she can't give tax advice. And the problem with that is their big box firms are prohibiting them from talking about these things. So it's an incomplete set of information. And so if your financial advisor isn't giving tax advice, or they don't have the staff that can do it, because look, it's not me giving tax advice. It's our CPAs, our enrolled agents, our tax planners that do all of that stuff.
Okay, if you hit this, is there a point? Because we've talked a lot in previous shows about habits changing, being willing to change. Is there a time that this has to be done? And is it this 2-year window that we're dealing with?
So we know that over the next 2 years, if things don't change, that we are going to remain in this efficient tax window. Now, the likelihood of extending it, because the big question is, hey, Stewart, how come they're not going to extend it? It's a great thing. Why wouldn't they extend it? Well, because when we had the Tax Cut and Jobs Act, they did it during the greatest economy the world's ever seen.
Yeah, we were in a little different space.
Yeah, what's changed? COVID, right?
That's one. That changed everything.
$9 trillion of additional deficit dollars.
That was then that took us to over $33 trillion in debt.
Yeah, so someone's got to pay for that. And it's a really hard pill to swallow to ask for a tax cut when we're that big in debt. I mean, shoot, they're even looking at cutting Social Security benefits for higher income folks. And so the benefit of converting now, of paying taxes on it now. And listen, everybody's situation's different. You want to find out what's right for you in your specific situation, but doing it now will basically do this. When you take your IRA money out and you have to pay taxes on your IRAs, it's also doing something else. It's also making your Social Security more taxable, okay? And look, you were told your whole life that if you put away this money tax deferred, that you could take it out in retirement and your income will be lower. Well, That may or may not be true. But what we know is true for a fact is that we are in an efficient window now. If you take money out of your IRAs and 401ks, that starts making Social Security taxable. And look, people come to us, they put away $500,000, $1 million in their 401ks, and they want to talk about those. But they never want to talk about their Social Security because they don't think it matters. And people are like, well, when we come in for our free review, we want to know why you want to see our Social Security statement. Well, it's so that we can consider it, because most advisors ignore it, right? They ignore it as part of the plan. But what we're seeing is between $1 million and $2.5 million of Social Security benefit. So why are we only focusing on the IRAs? It's because the advisors don't get paid to look at your Social Security.
And we talk about math winning all the time. If you don't do the math on the Social Security, you're losing.
It's crazy. It's absolutely crazy. And when people build up these big tax-deferred tax time bombs in their IRAs and thrift savings plans, they put themselves into a corner where they can no longer withdraw out of their IRAs before getting, taxed or penalized on Social Security and Medicare. There's something called IRMA, that's that huge Medicare penalty. And what ends up happening is people end up dying with all this money in their accounts and never having the ability to enjoy it. And I think that's a huge, huge problem.
So we've talked about real estate, we've talked about the IRAs, we've talked about the Roth conversion, and we've talked about taxes. What do you want people to do now that you say you should be doing now?
What people need to do is take action and have a plan. I say this emphatically because I'm telling you, you are going to look back. If you don't take action and have a tax plan as part of your financial plan, you're going to look back and say, I wish I would have done this. Because what it'll help you do is be able to take those vacations, enjoy retirement without having to worry about what Uncle Sam is going to say about it in the future. Because remember, if you have a 401k that's all pre-tax, it's not all yours. You owe part of that to the government. So why not do it at a discount where we are today? If you want help with your financial plan, where we also take a look at your tax plan as well, then give us a call at 833-602-7526 or click on that QR code and claim your absolutely free portfolio review. All you have to do is take action. We're here to help.
Is your advisor talking about investments, about taxes, about retirement planning, about insurance, about estate planning, about taxes? 833-602-7526. Let us help. Thanks for being with us. We appreciate your time. And until next time, we hope your retirement's great. We'll see you in the office.